The FTSE 100's recent ascent to a record high over 8,500 on January the 17th is primarily attributed to several interrelated factors. Firstly, there's been a series of weak economic data out of the UK, lower than expected GDP, retail sales figures disappointing, and that's all led to heightened expectations for the Bank of England to implement interest rate cuts. And this anticipation of coming cuts has bolstered investor confidence, leading to increased market activity. Secondly, when we have a weak pound, that does favour companies within the FTSE 100 that generate substantial revenues in stronger currencies like the dollar. So this is essentially a pay rise for those companies. Also, the energy sector has benefited from rising oil prices recently, and that's positively impacting major UK players like BP and Shell. So such sectoral performances have contributed to the overall uplift of the index. Moreover, UK companies have increasingly been engaging in share buyback programs, with FTSE 100 firms committing to repurchase at least £56.9 billion worth of shares in the last year. So this just underscores corporate confidence and has provided additional support. Now, seasonally, the FTSE 100 is quite interesting. From the 31st of January to the 17th of Feb, we see that there's an average return of 1.68%, an 8 out of 10 winning trade percentage, with a annualized return of 43.44%, a steady gain in the cumulative profit. So seasonally, it does favour upside for the FTSE 100, and this could be a trend that's going to continue into early February. Now, if you look at the FTSE 100, technically, we have broken out of this channel. It's almost like a flag pattern, but I prefer to call it a channel. We've broken to the upside. That means this 8,400 region is a very decent level of support, and you would expect potential buyers if price moves back lower. Now, there are risks with this outlook, as with all outlooks, and the main risk for the FTSE 100 is that the UK economy is in a particularly fragile place at the moment. There's also concerns that the moves in UK gilt market may be a sign of sovereign debt worries. Although analysts like ING play that down, it still is a risk that's circulating around and you need to be aware of. Sign up here for literally thousands more seasonal insights that are just waiting to be revealed.